As you have probably noticed, the dollar continues to give way versus most currencies, especially the euro. As we have said in the past, the need for dollars had caused tightened financial conditions around the world, something that is not good for the global economy, especially as we deal with the COVID-19 crisis. So a weaker dollar is a risk-on factor for equities. Many investors ask, why is the dollar correcting now? One reason are the liquidity swaps the Fed has opened with major central banks around the world. Currently, about $450 billion in liquidity has been provided by the Fed. These swaps are mostly used for euro-dollar funding needs and take a lot of pressure off major currencies. Another reason is the Fed balance sheet. As the Fed expands the money supply in the economy by buying assets, some of the money which might belong to foreign investors is repatriated, and thus in the FX market there is a demand for other currencies versus the dollar. Another reason might be investors are rolling over profits into other markets, especially Europe. As a result, cross-border investment flows in foreign markets are helping prop up many currencies versus the dollar. Finally, as we have said in a previous video, central banks know very well how to deal with liquidity issues. While liquidity is not the main concern during the COVID-19 crisis, it was nevertheless an issue, since the last thing central banks want is a liquidity issue to turn into a solvency issue. As you can see from the chart, the St. Louis Financial Stress Index is back to normal long-term levels. Long-term lower stress levels by default mean a lower need for dollars. Have a good weekend.